Good afternoon. Today we're joined by Thomas Holl. Thomas is a member of the BlackRock Natural Resources team, the team responsible for management of the BlackRock World Mining Trust and also BlackRock Gold and General Fund. Thomas is primarily responsible for mining and the gold sector, and he's also co-manager of the mine and gold funds, as well as the BlackRock Natural Resources Growth and Income Fund. Thomas, thanks for joining us today.
Thank you very much for inviting me along today.
The mining sector has gone through a period of fairly weak performance over the last 2 years, in part maybe down to slowing growth rates in key markets such as China. I wonder maybe if you could put those in context of sort of historic valuations and maybe say if this is a buying opportunity coming up.
Absolutely. I think it's first of all important to set China in context, because there's a lot of misconception and wrong headlines written about China. When we actually look at the mined commodities year to date, China has actually surprised to the upside on the demand side. You've seen steel production grow at 8% year on year, so higher than the rate of GDP growth, which is something that very few people were forecasting at the start of the year. What's happened in terms of the mined commodities year to date, though, is that there has been ample supply to meet the demand for these commodities as a result of the capital that was invested by mining companies in the last 2 to 3 years. Looking forwards, we see a number of the commodity markets that we look at to be in this balanced or even slightly oversupplied situation, perhaps for the next 12 to 18 months. But after that, we see selected commodities really begin to tighten, because many of the companies that we look at in our portfolios today have cut back significantly on capital expenditure. So forecast supply growth is coming down rapidly. And as demand remains robust, that's setting up a very interesting scenario in a year and a half to 2 years' time. In terms of valuation, you have seen share prices fall materially, and valuations have come down at the same time, though perhaps not to the same extent as some people might think when they see those share price falls. We tend to favour those companies today that have very robust balance sheets, and that those that have strong cash flow generation even at today's commodity prices. When we look at the higher quality companies, you see valuations that we'll look at, including dividend yield, of around about 4 to 4.5% dividend yields for some of the largest UK listed mining companies, for example BHP Billiton and Rio Tinto. Now, this is the first time for a long number of years that the mining sector has started to look attractive in terms of dividend yield versus the general market. The next question we get asked is, are these yields sustainable? Now, there will be the odd exception where they are not, and where the operations at today's prices cannot support that dividend. Those companies we don't own in the fund. Many of the companies, though, do have sufficient cash flow generation today and going forward to maintain those dividend payments, and in our view grow them as well, although probably grow them at a slightly more moderate rate than we've seen in the last, say, 2 to 3 years.
The gold price has gone through some volatile swings in recent periods. Is the investment or the long-term investment case for this commodity still intact? And how are you playing that in your portfolios? So in the gold funds, we are playing the volatility in the gold price, if you like, in a very conservative way. We have always run our gold portfolios with a focus on high quality and low cost companies. There are some people out there who are gold bugs who think gold should be at $5,000 an ounce even today, and would be buying the companies with the highest leverage to prices. That's not what we're doing, because while we think that in the long run the case for gold is very much intact, people are still concerned about the future purchasing power of paper currency, whether that be euro, yen or dollar, and people still want to have alternative assets that are a hedge against inflation. We do see that in the near term gold can be volatile, and we don't think
that our investors want exposure to the most risky companies, therefore, within that universe. Therefore, we are looking for companies that, if the gold price goes back to the lows of 1,200 that we saw only a couple of weeks ago, will still generate cash flow and have a robust financial position. At today's prices, there are some very attractively valued companies in the gold space. I would equally argue there are some value traps as well. And this is a great environment for an active fund manager, but it's one where investors have to be quite patient, because these value opportunities can take a number of quarters to be exposed as they go through several reporting seasons. And that's something I think we'll start to see with the first half results that are being published this week and in the next couple of weeks, and we'll continue to see that trend through year end.
A number of the portfolios that you run have an income yield objective, and we recently saw the dividend policy change from the BlackRock World Mining Trust, enabling it to pay a larger dividend. Are there lots of income paying opportunities in the stocks that you're seeing in your sector?
Yes, so as I previously mentioned, the dividend yields of the largest mining stocks within our universe are starting to get to really very attractive levels, both in relation to their own history and in relation to the overall market, especially given the strong capital performance of some of the more traditional dividend sectors that have been very well bid in the last 2 to 3 years as people have sought yield. What the current environment is enabling us to do, as many traditional sources of financing for mining companies have dried up, a lot of the banks who used to be lenders into this sector, for example, have withdrawn, and equity markets have far less capital to give to mining companies today. We're able to act as an alternative source of finance and put together investments that can generate very attractive yields that we can pass through to the holders of the World Mining Trust. And it's this type of outside of the box thinking that we've employed in the trust in the last couple of years with a number of the investments that we've made that I think are the real income opportunities in today's market.
One final question, if I may. If you were to highlight maybe one stock in your portfolio that is particularly attractive at the current time, what one would that may be?
The question will obviously on a tight leash as to what we can talk about, so I'll pick one of our top 10 holdings so I can go into that in a bit more detail. One of our largest holdings in the trust today is Rio Tinto. Now, this might not be an exciting small cap that everybody wants to hear about, but in today's market we think that a dividend yield in excess of 4% and a company that has been heavily sold off on the back of fears around the iron ore price represents a compelling medium-term value opportunity. When you look forward through the next 2 to 3 years, they will be delivering substantial volume growth, and even if you are to assume a bearish iron ore price scenario, the price that you're paying today reflects, in our view, a compelling valuation, and one that has lagged the equity market rally that we've seen in the last 18 months. So I would say, in terms of a risk-reward trade-off, that ranks very highly at the moment within our universe. It might not generate the highest percentage return in the next 12 to 18 months in the portfolio, but for the level of risk that you're taking on in committing capital to it today, it would definitely rank up there towards the top end, which is why it's such a large core position for the trust today.
Great. Thomas Holl, thanks very much for your time.